Hi everyone, welcome to Anu's classroom. In this video, we'll be talking about ratio analysis. While we were talking about annual reports, I hinted that we use a lot of different ratios to compare the profitability with the earnings and everything from the data which we get from the annual reports in order to decide whether or not to invest in a company. Right. So in this video, we'll be talking about that. We'll be talking about those ratios. By the end of this video, I hope that you will be able to understand what ratio analysis is, why we should learn ratio analysis, and what are the types of financial ratios. So let's get started. So the financial information which is relating to any business firm will be included in the three fundamental financial statements. That is the balance sheet, income statement, or also called as the profit and loss account, and the cash flow statement. These financial statements will summarize the transactions that are carried by the business enterprise over an accounting period in financial terms, and they need to be analyzed to gain better insights into the strengths and weaknesses of the firm. Such an analysis is undertaken by establishing relationships between different items of the balance sheet, like income statement and cash flow statements. So, what exactly is ratio analysis? Ratio analysis is an important tool that is used in the analysis of financial statements. A ratio simply means the relationship between any two or more things, right? In the context of financial statements, when any two or more items of the financial statements are expressed as a ratio, we call it financial ratio. To understand the performance of anything, be it individual or business, it needs to be compared, right? Either it has to be compared with itself or with its peers. And therefore, that is the importance of ratio analysis because it helps us in that comparison. A few of the types of probability ratios include profitability ratio, leverage ratio, efficiency ratio, liquidity ratio, coverage ratio, and valuation ratio. So there are many different types of profitability ratios like gross profit margin, net operating profit margin, return on equity, earnings per share, that is EPS, dividends per share, dividend payout ratio, dividend yield, earnings ratio, and earnings yield, and all those things. So basically, what these ratios compare is the ratio of profitability, that is the profit with the revenue. Okay, so either we may compare it with the profit, what you can say, the gross profit before the tax or the profit that is after tax, many different ways, and we might find out what would be the dividend per share, okay, or the cost per share, the earnings per share of the firm, and all those different things. A couple of these ratios, if you are able to memorize and go while you're writing a term examination, would be much appreciated, because we have had a few questions on and off in the previous term examinations related to these ratios. If you can't, and absolutely don't worry about it, because this is not the only question that you'll get in terms of essay questions. There will be it is always a multiple choice, what you can say, choice based term and examination paper that IGNOU gives us. So it's fine. If you get the time, I would much appreciate it. If not, then leave it. So again, liquidity ratio compares or tries to find out how much liquid that firm is. That is how easily that firm can liquidate its assets. So it has the current ratio, the quick ratio, cash ratio, net working capital ratio, and a lot many others also. So if you can memorize a couple of them and jot it down at the time of writing term and examination, in case it is asked, it would be great. Then we have leverage ratio, and mainly it is either the debt equity ratio or the debt ratio. Debt equity ratio is found out by first finding out the difference between by the long term interest bearing debts divided by any shareholders fund. And debt ratio is found out by finding out the long term interest bearing debt divided by the long term interest bearing debt plus the shareholders equity. Then we have the coverage ratio, which is mainly the interest coverage ratio and the debt service coverage ratio. And we have the efficiency or activity ratio, which could be the inventory turnout ratio, the work in progress inventory turnout ratio, raw material inventory turnout ratio, or the debtor turnover ratio, net assets turnover ratio, or creditors turnover ratio. Then we have investment ratios or valuation ratios, which are price to earnings ratio, that is PE ratio, market to book ratio, EV to EBITDA ratio. Okay, that is earnings value ratio to the earnings before interest and tax deduction ratio. And then we have Toblin's Q, which is market value of assets divided by the replacement cost of assets. So those were the various ratios which we use in ratio analysis. Mainly because these are formulas, I would suggest that pick up any few formulas which you find much better to memorize or easier to memorize than the rest of them from your MMPC 4 Unit 13, and by heart the formula and what that ratio is for. That's it. There have been questions related to ratio analysis on and off, like it's not a continuously repeating question, I would say, but we have had questions related to ratio analysis. So at least get yourself or make for yourself an overall idea of ratio analysis and go. That will be helpful. So I hope this video is helpful to you. Thank you so much for your attention if you have made it this far, and I hope to see you all in the next session. Bye bye.